Hey traders, I'm Michael Boutros, Senior Technical Strategist with Forex.com, here for a quick review of our Euro-Dollar 2026 H2 forecast. So we head into the start of the second half of the year with both the ECB and the Fed on a hawkish tilt as they combat rising inflation across the globe. In the last updated SEP, the Summary of Economic Projections from the Fed, we did see them slightly downwardly revise the growth potential for 2026 while improving the employment outlook and upwardly revising the inflation. Headline inflation seen at 3.6% for 2026 versus 2.7% from March, and core at 3.3%. This puts the dual mandate squarely on the side of the inflationary outlook, and with the new Warsh Fed, the recommitment or reaffirmation of the commitment to attain the 2% inflation target suggests that the Fed is going to be a little bit more aggressive in tackling this inflationary problem. If we look at the dot plot, you did see a shift in the median rate from the Fed funds from 3.4% to 3.8%. Essentially, there is a split, okay? You have 9 out of 18 members suggesting that we're going to have to see higher rates. You have about 8 members suggesting we're basically at the neutral rate, and 1 member suggesting we still have room for a cut. So while there is still dissension amongst the committee, the markets are pricing in the potential of roughly 63% we're going to see the Fed have to hike by September. And so this was a great shift after the Fed rate decision, where we saw Warsh come out with that recommitment to attaining price stability and stabilizing this inflationary run. And certainly with the projections that we've gotten and the higher inflation suggests that the Fed sees the inflationary problem here as much more deeply entrenched and well beyond just the inflationary shock we got because of the oil price surge and the Iranian war. So if that's the case, looks like the Fed is going to be tightening. On the ECB side of things, they are also expected to tighten, but whereas both central banks are tightening by necessity, the Fed is doing it from a little bit stronger of a position in that the growth and employment seems pretty stable. He specifically noted that the job gains have kept pace with labor, with the workforce, that productivity growth and capital investment seem strong. On the ECB side of things, the Governing Council did note concerns with regards to slowing growth, or the concern of slowing growth moving ahead. So that divergence in the policy might limit the ECB's ability or scope of how much they can tighten with regards to, or in light of the fact that growth is easing. From the charts, Euro is at a major inflection zone right into the close of June, right into the open of H1. The level is 1355. It's the basic 38.2 retracement from the advance off last year's low, but it's also the median line. This is the monthly chart of Euro dollar. This is the second consecutive monthly decline into June, right at that support. Momentum also approaching a support slope. So right into the turn of the month, we are at a major inflection zone. We'd need to see support at that zone. Now, if we break below 1355 on a weekly close basis, it would suggest the potential for a much larger pullback within this broader uptrend. Drill down to the weekly charts. Here's what it looks like. So the break that we saw last week into the close here of June is it was threatening a break of the yearly opening range lows. Here's that key support zone. 1355 into 1394. That's the April high close. That's the objective July swing low from last year. Both of those converge right there, and over the next few weeks, converge on the median line. So into the open of Q3, we are sitting right above support, so the short side might be vulnerable. If Euro's heading lower in the months ahead, rallies would need to be limited to 1578. That's the January swing low. And that's backed by resistance at the 52-week moving average. That comes in at 1664. Broader bearish invalidation, the level that would need to break to mark resumption of the broader multi-year uptrend in Euro dollar, is the objective yearly open, the 2025 high week close, and the 2025 high close. That gives you 1745 into 1775. That converges on the upper parallel basically towards the end of August. That's the break that would need to mark resumption of the broader uptrend. Again, break below this key zone would open up the potential for a much steeper decline and keep the yearly downtrend in focus. Subsequent targets are at 1228. That's the 2023 high close. Next major zone of support is a 38.2 retracement from the advance off the 2022 lows. You also have the 2024 high week close and the May low week close from last year. That gives you 111.10 into 111.63. All things held constant, euro is trading right into a major inflection support, right into the open of the quarter. If euro is heading lower on this stretch, rallies would need to be limited to 1578 on this recovery. A break below 1355 is what's needed to mark resumption and potential acceleration of this downtrend. The monetary policy on both sides of the pond are still both hawkish, but again, the Fed is a little bit on a more firmer footing. The risk to this outlook, the risk to US dollar strength, is if inflation begins to come down faster than expected, the Fed might have more latitude to hold rates where they are for longer. Okay, so inflation in this instance, if it does rear its head and starts to accelerate, or if we see prolonged, stickier inflation, that's going to call for the Fed to really maintain a more aggressive approach, and that might keep the dollar pretty well supported heading into the close of the year. As always, we'll try to keep you updated on X at MB4X. Best of luck trading in the second part of 2026. Have a good one, guys. Cheers.